Good afternoon, everyone, and thank you very much for tuning in to PFP's latest CPD webinar. My name is Chris Bridges from PFP, and I'm delighted to be joined today by Andrew Stanley, Managing Director of STax, who are professional partners when we're working with capital allowances and property tax. Andrew has got a really good presentation webinar today. We're going to look at the Common Reporting Standard and the lifeline that capital allowances could potentially allow for clients. We're looking to last around 40-45 minutes. Please feel free to ask questions as we go through. We'll answer as many questions as possible during the webinar. If we do run out of time, then we will get back to you via email and be in touch with you there. So Andrew, welcome this morning. Thanks very much for coming along.
Thank you very much, Chris, and good afternoon, everybody. As Chris mentioned, my name is Andrew Stanley. I'm the Managing Director of Stanley Tax Associates, or STax, as some of you will know us as. We've been working now in partnership with PFP for quite a few years, bringing forward their capital allowance offering, helping firms with fixtures claims and so forth. Today, though, we're going to talk about something a little bit different, and then just bring capital allowances in at the end to show how it can be a bit of a parachute for people who are affected by this. We're going to focus on the Common Reporting Standard that I'm sure all of you have heard at least something about over the last couple of years. We're going to have a bit of a look at what it is, who it affects, why it's been introduced in the first instance. We're then going to move on to the requirement to correct, which is effectively the HMRC action that they're taking off the back of the what is almost a global move in the CRS. We're going to have a bit of a look at what's happening up to the 30th of September. We're then going to have a look at what happens if you do comply with the requirement correct. And then penalties is what's going to be happening if you don't. And those of you who've seen this, you'll be very much aware the penalties that are kicking in from the 1st of October are absolutely eye-watering. So for those who are caught under this standard or the requirement to correct, because of overseas real estate assets, in many instances, capital allowances on fixtures can offer quite a substantial lifeline. So we're going to have a bit of a look at where this can help, how it works, how we go about effecting a claim in this area, and we're going to run through a few examples just to illustrate the impact of complying with the requirement to correct with and without capital allowances. Seems like quite a lot. I'm going to blitz through this pretty quickly. A couple of reasons. One, to leave plenty of time for questions at the end, but two, as I'm sure some of you heard me say before, I've never heard anybody complain that a webinar about tax was too short. So moving on, Common Reporting Standard, or CRS. Why do we have this? Well, back in 2014, the G20, the world's finance ministers and presidents and so forth all got together and decided that enough was enough regarding rampant tax evasion using offshore jurisdictions and simply people undeclaring income in other countries. And from this, a Common Reporting Standard was born. Now, what is a Common Reporting Standard? Well, as you can see there, that's a textbook definition. It's effectively the information standard for automatic exchange of information. In essence, requires all countries signed up to it to share information about the other countries' tax residents' activities in their jurisdiction, with the idea of eliminating or at least reducing tax evasion. Where is this in effect? Well, now over 100 countries have signed up to this. You can see here a long list of the countries that are either signed up from already doing this from last year, or a lot more kicking in from September this year. I've highlighted a couple of names you might be surprised to see on the list. People such as the British Virgin Islands, Hong Kong, the Bahamas, Liechtenstein, and so forth. These are all jurisdictions, even Switzerland's on the list there as well, which in the past have been associated with banking secrecy and to be honest, tax evasion. They will all be sharing information. So people who have been involved in offshore activities in these areas who think that the sun is going to keep on shining, they're in for a bit of a shock. Now, not everybody's signed up. Here's a selection of the countries that haven't. A lot of names that you won't be surprised to see, such as a lot of African countries or very small kind of Asian countries. But there is one there highlighted in yellow at the end that might surprise, and that's the good old United States of America have decided not to be involved with this. They feel that because they've got factor, which is obviously mainly one-way traffic going to them from everybody else, they don't need to be part of the CRS. And having states such as Delaware, some may say, I think they're rated the 3rd highest country for banking secrecy now. One of the largest offshore, well, what do you call them, onshore really, one of the largest tax havens in certain states. So unfortunately, the US is not signed up to this. So what is the CRS? Well, in essence, the CRS requires financial institutions of all forms, from banks to brokers, asset managers, insurance companies, to collect details from their customers to confirm in what country they're actually tax resident. They then send that to their tax authorities, who then share it with the countries where the individuals or businesses are tax residents. So, for example, HMRC. This has already been going on for a year. What sort of information will this include? Well, it covers bank interest, dividends, income from insurance products, assets, account balances, proceeds from sale of financial assets. In essence, anything that would have been taxed here that's occurring somewhere else. I mean, it's not rocket science. No, if you should have paid tax, if it happened in the UK, well, and it's happened somewhere else, and you're a UK tax resident, well, HMRC should know about that, because of course we all should be taxed on our worldwide income. So it's going to be a very, very wide net. And a lot of you, I'm sure, will be speaking to your clients about this already, or even in your own businesses, will have had your financial institutions writing to you to confirm where you're tax resident, what's your tax reference numbers, and so forth. So, one point before moving on, CRS and a requirement to correct is not just for the super rich. You see, good old Philip Green there showing the Common Select Committee just how much he really does care about the pensions of former employees of BHS. It's not just the likes of him that this is going to affect. It's anybody with any form of offshore undeclared returns of any format, income, gains, whatever it happens to be. So that, of course, will catch some of the super rich, but it will also catch people who have offshore accounts getting a nominal amount of interest on it, or even, and obviously what we're looking at, people who have maybe villas in Spain, ski chalets, commercial property overseas, who are in their mindset, they're doing a bit of letting, not a huge amount, they're paying local taxes, and they're just maybe incorrectly assuming that they don't actually need to redeclare here in the UK. It's going to catch everybody. So, bit of a question there for you on the screen. How many of your clients do you think might have holiday villas that they let out a bit that they haven't told you about? Hopefully you would have written to your clients already about this and have kind of shaken them up a bit to come forward with any sort of information about assets they may not have told you about. But there's always going to be a few out there that have slipped through the net, and they're exactly. Oh, sorry, Chris. So
just a quick one to jump in there. What would your advice be to the people tuned in and say, if they have clients that haven't disclosed, holiday villa in Spain or Portugal or Scally, what would you advise them to do about it, and what could they be doing? Bearing in mind the timeline's fairly short now, the end of September looming.
Well, we'll just stress, obviously, we're Capital Allowance experts. We're not CRS or RTC experts. The unfortunate reality is they've got assets they haven't disclosed. You won't know about it because of the very nature of the activity they're engaged in. What I would suggest, and everybody feel free to cut and paste the penalties page when we get there, send them a letter pointing out what is kicking in from the 1st of October. Send it out across the board, maybe a blanket email saying, this is happening from the 1st of October, this will be happening. If you have anything that you haven't told us about, now is the time to tell us. And of course, if they then carry on blindly ignoring that and thinking, I'll be fine, and then they fall foul of this, well, the upshot of that is maybe that you haven't protected them, but of course you've protected your practice from any sort of questions of negligence and so on. So what is the requirement to correct? Well, the requirement correct effectively is a window of time in which you can put your hands up and say, I'm really sorry, HMRC, I should have told you about this, and now I am. And up until the 30th of September, if you do that, you will only be hit with normal penalties and normal interest. Okay, so the penalty regime we all know now and love. Disclosed, prompted, unprompted, hidden, and so forth. So 0 to 30, 30 to 70, and so on. HMRC has said they are already sitting on a substantial amount of data, and they already have a large number of UK taxpayers in their sights to send letters out shortly after the 30th of September. Whether that's true or not, only they know. I'll be surprised if it isn't at least partially true, because they've been getting information through since September 2017 for about half the countries that have signed up to this. It is a statutory obligation to comply with the requirement to correct. It's not a voluntary disclosure regime. If you have income arising outside the UK, gains arising outside the UK, wholly or mainly, you need to tell HMRC about it. Because it's on a statutory basis, non-compliance with it has allowed them to really ramp up the penalties. Okay, so if you don't comply with the RTC, before moving on to the penalties, quick note on scale. HMRC have stated that the smaller offenders are going to be treated in exactly the same way as the habitual offshore tax avoiders or evaders. Ignorance is not a defence. It's never been a defence. Okay. RTC is not a prompt for penalties. Okay. So if under the current penalty regime, you make a disclosure during RTC's period up to the 30th of September, that's an unprompted disclosure. So depending on the conduct of the taxpayer, that means theoretically you could get penalties down to 0%. So if you're in this boat, or clients of yours are in this boat, complying with RTC, really is an easy decision to make.
Quick question just come in, Andrew. One for you. How does this? It's from Durham. Thank you very much, Durham, by the way. How does this apply to unremittable income? Is that one that you shed some light on?
That's probably one to have a bit of a chat about later on. As I said, we're much more capital allowance specialists rather than RTC or CRS experts. Apologies on that front. We're looking at this from a capital allowances on fixtures perspective, but of course PFP within the family do have experts that straddle all disciplines, and we can certainly get you some chapter and verse on that after the webinar.
We'll be in touch after the webinar, Darren. Thanks for the question.
Okay. So just coming back to where we are here, in essence, you've got until the 30th of September to put your hands up and come clean. If you've been a bit of a naughty boy or girl and you've got assets overseas you haven't told anybody about, because after the 30th of September, the gloves are off. And you're going to be facing absolutely eye-watering penalties. Penalties will start at 200% and may be reduced down to 100%, dependable upon conduct. This penalty itself is then multiplied through by an additional 50% if you've taken actions to hide the offence. Effectively, you started shunting assets around and trying to move them to the US. Furthermore, and this has been stated, this will only be in extreme cases, there'll be a 10% up to 10% of the value of the assets penalty applied as well. This is, obviously in HMRC's generosity, capped at merely 10 times the potential lost revenue, which in addition to the 150 to 300% penalty above, means that the maximum penalties could be 1,300% of the unpaid tax. This means, just to hammer this point home, if you've got 100K that should have been paid, then you could be facing a penalties charge of £1.3 million. Plus, of course, the original tax and interest. These are the kind of penalties that will bankrupt people or will take relatively small offences and turn them into massive issues for people who are affected by this. As mentioned before, it has been confirmed that penalties will apply to everybody, not only hardcore tax avoiders. This means that if you're like an innocent error or omission overseas will be punished much more brutally than a deliberate attempt to evade tax onshore. 200% is the standard. This may be reduced to 100%, which is still pretty brutal as it goes, dependable on conduct or quality of information provided during the inquiry process. 100% is still obviously an absolutely horrific penalty to be facing. So, I hope that's obviously got everybody's attention. Where do capital allowances come into this? Well, one of the assets, probably at the smaller end of the scale, probably one of the more common areas where people are going to fall foul of this is going to be offshore furnished holiday lettings. We're talking villas across the continent, ski chalets and so on, or potentially you may have larger residential buildings in which there might be capital allowance questions on the communal space, or potentially commercial property on a global basis. Regardless of what local taxes you're paying, if you're a UK resident, you should be redeclaring here in the UK, and of course you can claim capital allowances on the fixtures. So what are capital allowances? Well, on fixtures they are things like the electrics, the lighting, the plumbing, sanitary ware, lifts, fire alarms, whatever happens to be in the building. And these can form a pretty substantial write-off against the tax that's due. And of course, all the penalties in this area are tax geared. So you have an exponential impact that if the tax that was due comes down, of course, all those horrific penalties are also slashed down as well, along with the interest. And you can find that the benefit from getting your CA ducks in a row is pretty staggering. Now, here in the UK, and those of you who have listened to my past webinars will know that we have to contend with a lot of legacy issues on buildings. Certainly since FA12, where we've got the fixed value requirement and mandatory pooling requirement. This can restrict or block making a full claim on a lot of new acquisitions here in the UK. Offshore, we don't tend to come across these sorts of issues because you tend to find that the assets are being bought directly from the developer, or they've been bought from a foreign resident who obviously can't claim UK capital allowances, or potentially from somebody who's engaged in a non-qualifying activity. This means that in a much higher proportion of recent purchases, we can step in and make an apportionment claim of the purchase price of the building, okay? Because the plant and machinery that is actually in place when they bought the property is perfectly eligible for relief and forms part of the acquisition costs. But of course, we do have to go through an apportionment process to calculate how much that figure actually is. And fortunately, the Capital Allowances Act empowers us to do this in that Section 562 lays out how we should approach it. So just to give you, and this is not a capital allowances fixtures presentation, but just to give you 10 seconds background on how that would work, we effectively go in and survey the rebuild costs of the entire structure. We then have a huge spreadsheet for my tax team to analyze. We can then identify all the items that are eligible for capital allowances. We're then left by default with the items that aren't, so the walls, the floors, the doors, the ceilings, and so on. And we can also derive the land value using what we call a residual land value appraisal. So in this example, 25% relates to the plant and machinery. We can then take the part of this ratio that relates to the claimable plant and machinery and multiply it through by the amount of money spent. So acquisition costs of £1 million all in would result in 250k of new pool additions, which in monetary terms is £47,500 worth of corporation tax, or £112,500 worth of income tax. Now, that's not factoring in the impact that would also have in this application in reducing all those tax-geared penalties. So, a couple of figures here for you. Your average freehold furnished holiday let will be about 25% of the purchase price. Your average leasehold, because they have lower structural costs because it's shared between other units in the building, will be around about 30%. So it's a pretty large slice of the money that was expended to acquire the property. Generally very clean history, which allows us to make larger claims than you might find onshore. And there's no time limit on how far back in time we can look in most instances. So they bought the building 10 years ago, we can still pool against that expenditure in the more recent periods. And you might find if you get a phone call after the 30th of September from a rather panicked client of yours, and they've got this horrific letter in the post, well, HMRC is going to go and open those years, which will give you a further ability to claim the relief backwards. So if the purchase was 5 years ago, they open up 5 years under inquiry, then we can actually reference the allowances back into the year of acquisition, which will allow us to use the AIA and write a huge chunk off in one go. As I said, we're expecting this to be mainly furnished holiday lets that's it affects, but it's not just FHLs. Commercial buildings or potentially larger multi-unit residential properties will also have this kind of potential parachute there to use. So let's look at a few examples just to illustrate the kind of impact this will have if people are either complying with the requirement to correct, or they're getting that horrific letter after the 30th of September. So, bit of middle of the road, maybe property portfolio of offshore furnished holiday lets. There's probably a couple of villas, say in Spain, wherever they are, acquired 3 years. So we've got 3 years history up until 2017, which needs to be tidied up. The purchase price in sterling works out to exactly £500,000. You can see 2 columns there on the screen. On the left-hand side, we're looking at what would be the impact before or after the 30th of September without capital allowances being claimed on fixtures. And then the right-hand column looks at the impact with capital allowances. Okay, so we're looking at 25% fixtures claims. That's 125,000 going into the pool. So just going to run through in a little more depth on this first one, the 2 columns. So left-hand column, you've got £500,000 purchase price. We've assumed, this is professionally run furnished holiday lets. They're seeing a good return, say 7%, £35,000 worth of taxable profits. We've then assumed that the taxpayers in question are 40% income taxpayers. So that's £14,000 a year they should have paid here in the UK. Okay, so 3 years of that, total unpaid tax is £42,000. If they come forward under the requirement correct, we've assumed 30% penalties, so it's £12,600. If they don't, and they get a letter, say December, and then they get hit with a 200% penalty, or what has been really to middle of the road property investment, they're facing penalties in excess of £80,000 at 200%. Now, if we go in, make a capital allowance claim of £125,000 on fixtures, we can use the AIA, write that off completely. You end up, as you can see in that column there, with no taxable profits each year, and actually at the end of year 3, a £20,000 tax loss to carry forward. Now, this means the total unpaid tax is nothing, which means that the 30% penalty is also nothing, or the 200% penalty is also nothing. Now, of course, we're not a charity. We do charge for the work we do. We charge as a percentage of the new pool additions. In this instance, it would be 5. So the net saving, if they comply with the requirement to correct it, as you can see in the second to bottom row, is just shy of £50,000. And that's not even factoring the continuous tax benefits on the 20,000 loss to carry forwards. Or if they are caught by the higher penalty regime, we're talking pushing on £120,000 benefit to them. Now, of course, if this was an offshore bank account or some other source of funds, this isn't going to help them. But where it is property related, this of course can have quite a big impact on the overall outcome to the particular taxpayer. So ideally, we want to be, and we've still got time now, sending our surveyors all over Europe, getting these done beforehand, before the change kicks in on the 30th of September. We've still got enough time, and getting the history all squared up. That's the work we want, but of course a large proportion it's going to be people who phone you up after the 30th of September panicking. They've got this very aggressive letter from HMRC regarding their offshore holdings they've forgotten to tell you about in the past. So let's maybe look at a smaller example just to show it's not just the larger investors this affects. 200k purchase price, assuming a much lower rate of return. Maybe they're using the asset a bit themselves as well. 3.5% rental profit a year, so they're seeing £7,000 profit. So they're only not paying just shy of £3,000 worth of tax. Over the 3 years, that adds up, got £8,400 there. So if they're applying with requirement to correct, that's £2,500 worth of penalties. If they're not, we're talking nearly £17,000 for the 200% penalty from the 1st of October onwards. If we go and make the same percentage claim and so on, you end up with a large loss to carry forwards. So the net savings are either pushing on 8.5 or pushing on £23,000 on what is a relatively small and low profit furnished holiday let that's out there. So the numbers are still pretty chunky, even at the bottom end of the marketplace. Now, of course, if you've got a client who's got a large number of holdings, or if I say one very large property, the numbers escalate quite rapidly as you go up the scale. As you can see, £1 million purchase. Now, just to mention, that obviously exceeds the AIA. Well, actually, may not have done 3 years ago, but we've calculated some WDAs in there as well. But the bottom lines are either nearly £100,000 saved before the changes at the 30th of September, or nearly £240,000 saved afterwards. Okay, so for those clients who are affected by this, this really is a lifeline to help get them out of this hole.
Some quite staggering numbers there, Andrew, I think, certainly with the savings that could be made. Got a couple of questions that have come through, if I can just one that's come through from Arjun. He's got a client that owns a block of apartments in Germany. Can they claim CAs on an apartment block?
Yes, there's a restriction for dwelling space. So generally, in most instances, that means that everything beyond the front door of the apartments is out of the picture. So we're talking building-wise systems and items in the communal space. There might be a reception downstairs. There'll be, lights and fire alarms, carpets, lift, this sort of thing. If it's a particularly large building, they might have a gym in the basement, plant in the car park, and so on. So the figures are probably less exciting for those sorts of buildings, but by their very nature, they tend to be larger, more expensive properties. So it multiplies to being worthwhile.
Another one's come through. I think you tipped on this and mentioned it, Andrew, is what were the costs being incurred in looking at this? I think you mentioned in the slides is 5%. Give a bit more detail on.
Oh yeah, as a firm, we charge as a percentage of the new pool additions that we find and secure. Everything is linked to success. So in the unlikely scenario that HMRC questions what we've done, we'll answer those questions at no further charge. And if there's a haircut on the claim, then our fees are pro-rated. That's only happened twice in the whole history of the firm, I should stress. We don't charge any fixed fees of any format at all. We do stagger the fee, so it's 5% of new pool additions for expenditure $1 million or less, and it's 4% above. If, of course, we're looking at a larger portfolio or particularly expensive assets, then it comes down to a bit of to and froing with the clients.
One more question has come through here from Anne. Have a client that has two very small FHLs. You mentioned the smaller end of the scale. Is there a de minimis that you would look at?
Unfortunately, there has to be. We're generally looking for £200,000 worth of expenditure or more, because otherwise we incur more costs doing the work, doing the survey, especially if it's international, flying our guys out there and so on, that we're able to charge. But if there's two and they're quite close to each other, then we could look at them as joined together. So I'd say give us a shout. Maybe best if we speak afterwards. We hate to turn work down. We feel it's bad business karma, but there is, of course, the point where reality kicks in and we simply can't do it and run at a loss.
Thanks, Andrew.
So, in essence, there is still time to act, but only just. So, if you haven't spoken to your clients about this, I would strongly urge you to put together a letter, detailing the importance. Either send them the post, send it by email, give them a call as well. Just double check there's not anything they should have told you about in the past. So, of course, there are other capital allowance firms out there. We wouldn't recommend you use them, of course. But why use us? Well, we're a professional firm like you guys. We're a mixture of tax advisors. I personally sit on the Chartered Institute of Taxes Property Taxes Technical Committee, which really needs a snappy acronym, where we help advise people like the Treasury, the Office of Tax Simplification. I personally was involved in their consultation this year regarding the Treasury's brainchild of ripping up the entire Capital Allowances Act and moving the tax allowed depreciation, which fortunately has now been kicked into the long grass. I have certified chartered accountants with a heavy tax focus on the team. All of our surveyors are RICS members. One of them, except for one who's MCIOB, which is a member of the Chartered Institute of Builders. We've got a whole host of part qualified tax professionals and so on. So you have all the same code of businesses, indemnity requirements and so on with us as you would expect with yourselves. So your clients have all those protections in place. We've been in the sector the best part of 10 years. As I said, we only charge as a percentage of what we deliver. We are here to maximize the benefit to your clients, but we do everything in a transparent manner, and we are not going to put forward anything we're not 100% happy having a chat with HMRC about, which, touch wood, over the years has meant they don't generally want to have a chat with us about anything. We provide a full disclosure report, which is sent along with tax returns to HMRC, lays out exactly what we found, where we found it, how we found it, photographs, the pool to get floor plans, so that gives them everything they need to look at it and say, yes, this is what we would expect. Track record to date, everything has been successful. We've only had 2 small reductions in the whole history of the firm, the vast majority of our inquiries being agreed at the original value. We do the work, in that I mean that we're not going to push it back on you or on the client by asking them to do all sorts of digging, especially with international property. We're the ones who are going to have to contend with the French land registry and getting documents translated and so on, not the clients. At the end of the day, we're being paid to do the work, so we don't see why we should push it back on somebody else. If anything has hit a chord today, We can provide a whole host of resources. We're also happy to chat about any individual cases. We often work, especially with PFP partner firms, to do a full client bank review, so we can sit down with you in your offices and go through A to Z to see who this may or may not be relevant to and what are the hot potatoes. If your clients are buying or selling buildings, we can help you guide them through the conveyancing process, providing example clauses, pro forma documents, and so on. And as you know, PFP particularly hot on nice glossy marketing brochures. We've got some dual branded S-Tax PFP, Capital Allowance flyers and so on that we can of course provide you with. Anything that we can do to assist you to promote or to spread the word to your client base, but we can certainly engage with. So that's everything today. So I hope we've covered a bit about the CRS, so you know what it applies to. We've looked at the requirement to correct what it is, what happens if you do comply with it, and if you haven't taken anything else away, I hope Penalties has inspired you to maybe look a bit further in this area. And for those people who are in the sights of HMRC, who, because of overseas real estate, the Capital Allowances lifeline has maybe calmed some fears there and give you a bit of an idea of some of the things we can do.
Certainly, I think that the chord to strike with this is penalties chords. Really should strike a chord with a lot of clients out there, hopefully. We have had quite a few very technical questions come through in relation to Common Reporting Standard. We'll follow those up after the webinar rather than trying to sift through those now. A few of you have been asking if copies of the notes and slides will be available afterwards. We'll get those sent out to you via email. And for any of your colleagues that may be interested, we'll also have a recording of the webinar as well. You'll have our details, I think, on the next slide, so please do feel free to get in touch if there's anything you want to chat. And we have just hit over the half-hour mark here, so Andrew went through it a little bit quicker than we thought, which is the first time I think Andrew's done that. But thank you very much for attending today, and we'll hope to see you soon on our next CPD webinar. Thanks very much.
Thank you.